Going back to the early 90s, when I was still a pretty new financial advising practitioner, I was an early baby boomer, as were many of my retirements, and they were just beginning to think seriously about retirement with about 20 years or so left. So they started asking me questions. How much do I need to save? How much can I withdraw? What kind of lifestyle can I enjoy in retirement? And I had no clue, quite frankly. This is new to me. Now it's actually new to the world because our generation is probably the first one that's going to have such a long life expectancy in retirement. It really has to worry about having 10, 20, 30 years or more of funds available. And so I decided to study this on my own because I couldn't find answers anywhere else. For that particular client, was the worst case in history, at least the last 100 years. And I put out there as a number of 4.15%. It got truncated to 4 by culture, and then most became a rule, which was not my original intent. It was supposed to be just applied to a very small number of clients who were very, very conservative. Since then, I've continued my research, as you mentioned, and I have made it more sophisticated, primarily by adding more investments to the portfolio. So now I have something that resembles a diversified portfolio I'm doing my calculations with. And the 4% rule has now become the 4.7% rule. The withdrawal rate is very sensitive to your time horizon. The longer you're planning for, the lower your rate goes. Let's say with a 4.7, with the 30-year folks starting out 30-year with 4.7%, it will not drop below 4.1%, even for 50, 60, 70, 80 years. It kind of reaches a floor, which is good news. A result of the fact that you spend longer time in the market, you'll make more money. So it offsets the effects of withdrawing over that very long time period.
So you heard it here, firees. We don't need to pick 3.25% out of thin air. We don't need to pick anything under 4% out of thin air. We can spend more in retirement and use the 4.15 or 4% rule as our floor. Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm Bill Yount with my wonderful co-host, Jackie Cummins-Koski, and we have a repeat guest and a surprise guest today. We are so excited to welcome back to the show Bill Bengen and his wife, Barbara. It's going to be a great conversation. Jackie, what do you think?
It is going to be amazing. The last time he was on the show, the book didn't even have an official title. So we promised that we would bring him back. So this is such a treat, and we get a bonus guest as well.
If there's one person in the world that doesn't know who Bill Bengen is, we have to introduce you. And maybe in our audience, there are people that are just getting started and need to understand the importance of your research to retirement these days. So our guest is Bill Bengen, one of the most influential figures in the financial planning industry, and best known as the inventor of the infamous 4% rule of thumb. This rule suggests that retirees can withdraw 4% of their savings annually, helps us figure out our FIRE or our retirement number. It's adjusted to inflation and makes their savings last for a 30-year horizon. So Bill's research and publications have made significant contributions to the field of retirement planning, helping countless individuals and financial professionals better understand how to manage retirement funds effectively. And that's an important point about this book. It's much more consumer-facing as well as for financial advisors. It's both sides of the equation. It helps us speak the same language as our advisors. And so that's why it's so important as consumers to read this. So Bill's groundbreaking work was published in October 1994. That's the original paper about the 4.15% rule, which became known as the 4% rule. And it forever changed our approach to retirement planning. He built his original findings from extensive historical market data to determine a safe withdrawal rate.
Well, that was 30 years ago, and he still has a lot to say about it. So, beyond his research, Bill Bengen has been an active voice in the financial community, frequently speaking at industry conferences and contributing to leading financial publications. And his insights continue to shape the strategies of the FI community and retirement professionals. We talked to him last year. And when we did, we promised that we would bring him back when his book was finished. So we kept our promise. And that book is Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More. He explains how we can draw heavily on our retirement accounts without spending ourselves into premature poverty. So, Bill and your special guest, wife Barbara, welcome back to the show. And how are you guys doing today?
Great. It's really great to be here.
It's so exciting for us to have Barbara. We have not heard her on a podcast, and we got into this a little bit last time when we talked about your personal history. But Barbara, tell us a little bit about how you met and your history with Mr. 4%.
Well, both of us started from kind of a dark place. We both had lost our spouses, and we were in a bereavement group that meets regularly here in our community, and got to be friends over the years. And then friendship became more, and we became Mr. and Mrs.
Was Bill quite the smooth talker, Barbara?
Oh my God, yes. Absolutely.
What a reputation I have.
And he kept our bereavement group in stitches. It was wonderful because all of us were hurting. We were all in pain. And he had such an impact on the group. He knew just the right time with his comedic sense of humor to just interject something that kind of brought us out of the gloom. And he really made a difference and touched a lot of lives.
Well, that's important because his sense of humor comes through in the book too. He's kind of like a Brit in a way because he has this little dry, witty, insightful sense of humor. I absolutely love it. And the color in the book, you got to pay attention to it because it's there and it makes it fun.
You guys show that it is never too late for love or never too late to find love again. Now, I did look at the very beginning. Bill loves to read the nuts and bolts, but I looked at the dedication at the front of the book and it said, "To Barbara, my wife, how, oh, how did we find each other?" Just short and sweet. And I thought that was lovely. We just wanted to say hi to you. We wanted our audience to meet you. The way that you guys connected at a very tough time is just the sweetest thing. And we left off last time without really being able to get into it. And I'm like, that is so cool. You guys give me hope.
That inscription I wrote in my book really reflects my sense of amazement at finding a soulmate at my age. It just was wonderful.
Yeah. And Barbara, did you have a financial planner before with your husband before he passed away?
We did have somebody that we worked with, but then when we moved to Arizona, I didn't have a financial planner anymore, but we did before we moved here. Yeah.
Did you manage the finances in the family? Did your husband? How did that work?
Well, both of us were very heavily into our careers. And so I paid very little attention to financial planning. In fact, everything I know I've learned from Bill. But then he's an easy teacher. He just has a way. I've been to so many of his speeches and when he's talked at conferences or just to groups of people, and he just has a way of sitting there and talking to you about it in a way that you can understand it. I never understood it before. And so I really learned everything that I know basically from him.
And one thing that happens when a spouse passes away, if you haven't been necessarily paying attention to the finances, is that there's a potential overwhelm with how do I do this? Did you have that issue?
No, because I think I had enough of a basis. I had been through not only my own personal financial planning with my previous spouse, but my parents' financial planning when they had set up like their trust and stuff like that. And my mother was a whiz with money. My parents were both teachers, and my mom turned them into multimillionaires. And not too many people do that on a teacher's salary. Think about that for a minute. And she was a whiz with money. And so I did pretty well with money. In fact, I was the one that kind of drove the money a little bit with my previous husband because I kind of had a feeling for it more than he did. When you grow up with it, that makes a difference.
That is great to hear because, Bill, from your time as a financial planner, is that a lot of times it's the opposite, where it's the male in the partnership that typically will focus on the money. So I'm curious, Bill, was Barbara a good student?
Well, Barbara is a brilliant woman. So, yes, she absorbed like a sponge.
But he's a good teacher.
It sounds like to me Barbara was a pretty savvy person with finances, which may have been part of the attraction.
It sounds like her parents really started early with their own finances and really taught her that. And it's a great example. From relatively humble beginnings, you can become multimillionaires, 2 teachers' salaries. And what better way for a teacher to teach their kids to handle money properly? The legacy you have with your parents as a child that grew up with a healthy relationship with money, as it sounds, that bodes really well for a very happy retirement where you're not worrying about the numbers, right?
That's right. Absolutely. And while my parents were acquiring the wealth, meanwhile, they traveled the world and did all kinds of things in their retirement. And they had 2 homes, one in Florida and one in Wisconsin. So even though they were like saving towards retirement or in retirement, they were able to do just wonderful things in their life.
That is awesome. And is today the official launch date? We're recording this on August the 6th. Was this the official release date for the book?
Actually, it's yesterday.
Yesterday. Okay. We missed it by a day, but huge congratulations. Barbara, I know you are congratulating and celebrating with him. We see you all over social media. And Bill, you could not have a better cheerleader, but it's just so much fun watching you guys with the book launch. And to me, the luckiest person is Wiley, your publisher. They were the ones that got the Bill Bengen to publish this amazing book. So the confetti is falling down, we are blowing the whistles, and we want to congratulate you and celebrate you on the launch of your book.
Thank you so much. Very kind of you.
Let's dig into the material because we want to give folks a sense of what's different. Bill came up with the 4% rule back in 1994. He was busy working and using it with his clients. He's retired and his research is ongoing. It's ongoing after this book. And it's really heartwarming to see that somebody who's been a practitioner of this science and doesn't necessarily come from an academic background gives us a practical approach to how we should plan for our own withdrawal rate. And there's a lot of buzz about withdrawal rates in the community now. There's folks that say, oh no, you got to be 3.25% for a 50-year retirement, or oh no, you can actually spend 5 to 6% or more. It's a wide range. And Bill gives us a sense of how we calculate our own individual withdrawal rate, which is so important, and how we monitor it. Let's dig into the story. Thank you, Barbara, for being with us to add some color to the show.
I enjoyed it. Enjoy your time with each other today.
Thank you.
So, Bill, there's a lot of elements to this book. Just give us a brief history of the 4% rule, which we've lived with now for many, many years, and why you decided to write this book and update the data and the information. And we'll go into some of the things that change in order to help you supercharge folks' retirement. But give us a little snippet history, and then we'll jump into the Mr. 4.7% rule.
Yeah, going back to early 90s, when I was still a pretty new financial advising practitioner, I was an early baby boomer, as were many of my retirements, and they were just beginning to think seriously about retirement with about 20 years or so left. So they started asking me questions. How much do I need to save? How much can I withdraw? What kind of lifestyle can I enjoy in retirement? And I had no clue, quite frankly. This is new to me. I was actually new to the world because our generation is probably the first one that's going to have such a long life expectancy in retirement. It really has to worry about having 10, 20, 30 years or more of funds available. And so I decided to study this on my own because I couldn't find answers anywhere else. And I really attempted to find out historically, looking at historical data, what was the worst case scenario that anyone could be exposed to. And that applied to the person who retired in October of 1968, who ran into a buzzsaw of several major bear markets right after retirement, which damaged their portfolio. And then suffered through a year of high inflation, 8-9% on average, which forced them to increase their withdrawals every year, which is another drain on the portfolio. So for that particular client, was the worst case in history, at least the last 100 years. And I put out there as a number with 4.15%. It got truncated to 4 by culture, and then also became a rule, which was not my original intent. It was supposed to be just applied to a very small number of clients who were very, very conservative. Since then, I've continued my research, as you mentioned, and I have made it more sophisticated, primarily by adding more investments to the portfolio. So now I have something that resembles a diversified portfolio I'm doing my calculations with. And the 4% rule has now become the 4.7% rule. And I don't think that's the end. I suspect I'm still understating retirement rates by a little bit because I don't have all the investments that people might have in their portfolio, like REITs and then Bitcoin and emerging markets and commodities, precious metals. I think they would enhance the returns even further and likely lead close to a 5%. I think we'll end up with a 5% rule rather than 4%.
Well, that's fascinating. One word we got to get clear before we jump into this data is you use the term safe max with this 4.7% rule. You didn't really use it with the 4% rule, but can you define what safe max means for us?
Sure. Yeah, I didn't create that till I did my 2006 book. Essentially, it's looking at historical data. What is the lowest safe withdrawal rate that any investor experienced during the last 100 years of history, which was forced on them by market circumstances? And that safe max now also applies to any individual who can have their own safe max. If you're retiring this year, we can calculate a safe max for you. And so it applies not only to the worst case, but applies to each individual as well.
So that's the safe maximum withdrawal rate. So that makes sense. Now, I wanted to step back for just a second because as you said, you were continuing your research. Before, when you wrote the book and most of your research, it was geared toward financial professionals, financial planners, financial advisors. This book, you chose to write it for consumers. Can you talk to us a little bit about how the framework might have been a little bit different in your approach to touch individual consumers versus the planning industry?
Starting this book, I felt that I had to have no assumptions that readers were going to have the sophisticated knowledge of investing and financial planning that an advisor would. So I took great pains to avoid jargon where I had to use technical terms. I tried to explain it very directly and straightforwardly, and hopefully I succeeded.
Yeah, I really appreciated you doing that. You're just touching so many more people than if it was just the planning industry or even one-to-one clients. So this is a gift that you've given to individual consumers. And that's part of why we were so excited to kind of walk through a few things with you. So Bill, where did you want to start? My co-host Bill, not Bill Bengen.
Well, I want to circle back to the retiree that you used for essentially the 4% rule and the 4.7% rule was, I think, the October 1st, 1968 retiree that really had the roughest time in retirement. That's correct, right?
That's correct, yeah.
Yeah, it's important to know that this is a worst case scenario. Do you see the 4.7% rule now as more of a floor to withdrawal rates as opposed to a ceiling?
Absolutely. Yeah. Historically, over the last 100 years, the average retiree has been able to take 7%. So 4.7% is quite a haircut, and it reflects how awful the economic situation was back in the late 60s, early 70s.
Yeah, I mean, actually, with regards to this safe max, historically, where did it start a decade or 100 years ago? We've seen a decline to today's rate. Can you give us a little bit of a history lesson there?
Yeah, I think if you look at my database goes back to 1926. So the first withdrawal rate I had from the earliest retiree was around 5.75%. Then, the Great Depression hit and that huge bear market, that dropped it down a bit more, probably to about 5.25. And then finally we came into the 1937 was another bear period. That hit it hard too. That was like a 50% drop in the stock market in a year, which is kind of scary. And then we hit the 1960s. The worst conditions prevailed, and that drove it down to the 4.7% level.
Do you think it's going to go down from here, or have we hit an asymptote where it's going to level out for history?
I sure wouldn't want to predict that because I honestly don't know. I think it's important to keep in mind that it's not an immutable law like Newton's laws of motion, that if conditions present themselves which are worse than they were in the 70s, we could end up with a lower number.
Well, there's 10 variables that you use in figuring out somebody's individual safe max. People talk about the 4% rule or 4.7% rule like it's dogma, but everybody is different. Personal finance is personal. And what you need to realize, in order to figure out what your own personal situation is leading to your own individual safe max, not only do you have to read this book, but you've got to go through this scenario, these variables. And there's two conditions that you start this calculation with. The two of them are inflation and sort of a CAPE ratio valuation. Take us through the evolution of your thoughts on that.
Back in 2008, a colleague of mine, Michael Kitze, he's a brilliant financial advisor, published a paper in which he studied withdrawal rates, comparing them to what the stock market value was each year, computed withdrawal rate, safe withdrawal rate for each year. And when you put the two charts together, it's pretty clear that when the stock market gets expensive, withdrawal rates are low. When the stock market gets cheap, withdrawal rates are high. It's a wonderful correlation, which is not enough to really narrow down the field for withdrawal rates by itself. But if you enter inflation into it, inflation, of course, affects the amount you withdraw. You can really get a high correlation between what's happened historically and what you might expect in the future.
Do you look at inflation first or valuations first? And you talk about inflation being the ultimate enemy of the retiree, and sort of the CAPE ratios, we can survive those potentially in isolation, but inflation compounded on top of that can do real damage to our portfolios, right?
It really does. And a good example of that is during the 1930s, you had a bear market, lasted for 3 years and declined about 89% in the market. We haven't seen anything like that since. Yet that was not the worst case scenario. And the reason, of course, is that during that 30s, deflation was prevalent. Actually, prices were dropping 10% a year for several years in a row, so that you're actually able to reduce your withdrawals, which helped offset some of the terrible losses in stocks. When you come to the 1960s, you get the worst case, you get the worst of both worlds. You get high inflation, high stock market valuations. They conspired to really devastate portfolios.
We all obviously know what inflation is, but I wanted to ask you to briefly explain what CAPE ratio and the valuation stuff that you're talking about, what that is.
Robert Shiller is a professor at Yale and a Nobel laureate, and he developed the concept of the Shiller cyclically adjusted PE ratio, which is intended to measure, let's say, the S&P 500's valuation, all the 500 stocks as a group. And the key to his approach was that he used 10 years of earnings rather than 1 year. Most of the stuff you hear from Wall Street is 1 year, which is not worth very much. And he also adjusted for inflation. And since then, he made another sophisticated adjustment to his ratio, which I haven't tested yet. But it's become a benchmark in the financial services industry for measuring the valuation of the stock market. And the valuation of the stock market is very important because it's very closely correlated with the returns you might expect in stocks over the next 10 to 12 years. The more expensive the market, the lower the returns, and vice versa.
So we've got our two sort of constructs or variables there that we've got to really look at in order to template out our safe withdrawal rate. But then there's sort of 8 elements that you talk about that we have to look at as well. And then maybe we'll go through at the end of this using your standard configuration, calculate a safe withdrawal rate or safe max withdrawal rate. But the number one thing, the first thing you've got to get your clients to think about is a withdrawal scheme or strategy. And there's several of them. Which one do you use for your research, and what other ones should we consider?
I use what's called a COLA, or cost of living adjustment withdrawal scheme, which works very much like Social Security. The first year you determine by some formula, which really means taking like 4.5%, multiplying it by the value of the portfolio, and that gives you your dollar withdrawals for the first year. For each successive year, you throw away the 4.5%, and you simply give yourself an adjustment based on the Consumer Price Index, CPI, so that the idea of that approach is to keep your lifestyle constant through time against inflation. But of course, that's not the only way to look at it. As you mentioned, there are other alternatives to withdraw.
Yeah, let's go through them briefly. And we keep coming back to the COLA as a really good way to do it. And we have to make sure our audience understands that the CPI is sort of a global inflation index, but our own personal inflation rate can be dramatically different, right, Bill?
It certainly can. Let's say, for example, a large portion of your budget was a payments of a fixed mortgage, which didn't vary. So it's not going to go up with inflation over time. So your inflation rate might be lower than your neighbor's.
That's a great point. And I'm also thinking if it's somebody much older, let's say they're in their 80s and they're a much bigger consumer of healthcare, where the inflation rate of healthcare services is typically a lot more than general inflation. So would that also kind of be what you're talking about?
Well, yeah, if you're talking about personal inflation rate, you have to build those expectations into your long range budget. I mean, I saw my health insurance premium go up by 20% this year. That is painful.
I guess we can potentially even work through calculations if we have our spending data on our own inflation rate. You could use that to figure out your withdrawal rate for the next year, which may not elevate your payments as much. But if you want to spend more money in retirement, maybe you should use CPI, because one of our friends, Frank Vasquez, talked about personal inflation rates being the standard inflation rate minus 1% to 2%. So definitely think about that. Inflation, again, just like your own safe withdrawal rate, is variable to your personal situation. So some of those other withdrawal strategies that people need to think about, and we don't need to drill down on the specifics of them, but just to give us a flavor of them and to get people to go read the book and find out more about them. You talk about a fixed annuity method. Can you describe that for us?
Yeah, essentially that approach involves just simply deciding on a dollar amount you want to take out each and every year without changing. Let's say you want to start 5% of $1 million portfolio, you take out $50,000 a year every year and not worry about inflation. That's one way to look at it. I think it has limited applicability. By instance, it could apply to somebody who's using that account to pay off a fixed mortgage over a long period of time. That would work pretty well. And then, of course, some people want to spend more early in retirement. So they'll boost expenses and then after 10 years cut back. And that's a legitimate way to look at it. You just have to be prepared when the cliff comes, when you have to drop your expenses. It could be 30% or more. So it all has to be thought out and understood in advance, so you're not taken aback by what happens.
I'm seeing these two fixed methods as one is a fixed dollar amount, like the $50,000 that you mentioned, and the other fixed one is a percentage of what's left in your portfolio.
That's right. That's another one. Call it the fixed percentage method, of course. Basically, you take like a 5% number, and then each year you apply that to the beginning value of your portfolio. So if your portfolio fluctuates in value, so your withdrawals, you have to be able to tolerate, let's say in 2008, a lot of people saw their portfolios drop by 25 or 30%. You have to be able to accommodate a reduction in your income of that amount for that to work. Well, the great advantage of that method, though, is that you never run out of money. Even if you got 1 cent left in there, you get 5% of that. But it works well in terms of worry about whether you're going to outlive your money, because you never will. The question is, can you handle the fluctuations?
In some ways, you could even, with the fixed annuity method, think about segmenting your portfolio and creating your own annuity for your floor expenses, and then have a growth portfolio. You can do a liability matching approach where you've got your basic expenses of housing, transportation, travel, and food covered. And then for the future, and to avoid succumbing to inflation, you could have part of your portfolio that's a growth portfolio that covers sort of discretionary expenses, right?
Yeah, I mean, that makes a lot of sense.
So we've talked about the COLA, the fixed annuity, the fixed percentage. We did mention the front-loaded, which I think is becoming very popular now because we have our go-go years, our slow-go years, and our no-go years. And we know from David Blanchett that there's a retirement smile according to spending. And so front-loading isn't a bad thing as long as you plan for it so that you don't end up getting shortchanged later on, right?
Absolutely correct. You got to be aware of that going in.
So, Bill, I have a quick question about the front loading thing. So when I think of front loading, obviously it's going to be in the younger years and you might not spend as much, but is part of the reason you might not spend as much is because things like Social Security might kick in, or maybe there is a pension that doesn't kick into your later years. Like, does that factor in?
Well, that'd be a complete financial plan. I basically just look at what's coming out of the investment account, trying to maximize that without taking risk. Clearly, you have to consider other sources of income to have a complete financial plan during retirement.
Yeah, that would affect your safe withdrawal rate because Social Security is the best inflation indexed annuity, basically, that can help you cover your floor. And if you have a pension, even more so. And you may not even need your portfolio, but a lot of the trouble that people are having in today's FIRE movement is spending and switching from saving to spending and not being so frugal in retirement and living a rich life.
I'm encouraging people to spend in retirement up to safe levels because you spent your whole lifetime building that wealth. And it's a real shame to not enjoy it at a time of life when you plan to do a lot of enjoying.
I'm curious, Bill Yount, which one of these strategies do you think you will end up implementing? You're nearly 60, so I know you've been thinking about these things.
Yeah, I mean, I'm a little bit torn between the COLA method and the front loaded method. I'm 60, Social Security is not too far away. I'm going to take it at 70 for the maximum monthly amount. I think I can front load, but in order to get that squared away, I'd have to talk to a planner because we have to stress test this to make sure that I don't get caught with my pants down like Warren Buffett as the water goes out in 10 years' time when things start to need to take a haircut.
Yeah, I think I'm definitely on the front loaded side because when I was doing my planning, I didn't include Social Security at all. So now I feel like I can front load because I'm going to have this fixed amount adjusted for inflation for the rest of my life that I didn't factor in the beginning. So I'm a totally front loaded gal.
Okay, good for you.
Yeah.
That's a perfectly legitimate approach.
Are you following your COLA method or are you doing it differently, Bill?
I started with a COLA method, and that's worked well for me. Basically, my expenses have been pretty much growing with inflation, except for the healthcare area. But I have enough left over in the budget that I can make gifts to my children, which is nice to see them enjoy the money while I'm still alive. And good years, I can give them a little bit more.
Yeah, we'll talk about that legacy as part of the plan. I think that's number 4 in your list. Number 2 in your variables list here is planning horizon. That becomes critical. Now, the FIRE community gets really worked up about, okay, I'm going to retire at 40. I've got a 50-year horizon, and the 65-year-olds have potentially a 30-year horizon. Tell us about tweaking that variable, moving that slider of retirement horizon so people know that they can calculate a true safe withdrawal rate that may not be the 3.25% where they're frugal down because they're so fearful that they have a long retirement.
Sure. Important to start with the 4% rule, which is now a 4.7% rule. It's based upon a 30-year planning horizon. So you're looking for your money to last exactly 30 years. People don't know how long they're going to live. And therefore, I'm an engineer. And one thing I learned when I was in engineering training is to build a margin of error into your project so that if you think you're going to have a life expectancy of 30 years, retired 65, live to 95, maybe you should plan for 40 years so that if you live longer than you expected, you won't run out of money.
Yeah, we actually have a friend, Frank Vasquez, and he's been very open about this. His parents basically ran out of money in their mid-80s, and they didn't realize they're in their mid to late 90s now, and his financial plan luckily accommodated for being able to support his parents in retirement, because we don't know these other factors, but then there's family variables too, right?
Yeah, absolutely. That's an interesting story. And the parents are very lucky to have somebody with that much foresight and resources to help them because most people won't. Most people, in fact, don't want to be a burden on their kids at all. They'd rather not. That's unfortunate what happened to them. I wish they would have known about the 4% rule when they started.
Yeah, that's right. That's why we have to have these conversations in our family and be transparent with our finances. His parents weren't transparent. His dad was actually a doctor, much like me. We doctors aren't necessarily good with numbers. And it's great to have that conversation with your parent and say, okay, how are you doing? Do I need to worry? My mom, for example, gave us the great gift as a late starter. She worked from about 55 when she got divorced to 70, and she's taking care of herself the entire time. My dad has done the same thing, so I really don't have that worry as far as I know, but we are not as transparent about talking about our own financial situations with our kids and our parents, and we have to have generational literacy and generational conversations because money is not taboo, and that's what we're talking about.
Yeah, money very important. I remember sessions I used to have with clients and their kids discussing the parents' estate plan. letting the kids understand exactly all the details of that. It's important to share within the family, but it impacts everyone.
Yeah, and this 50-year horizon that our firees worry about, I mean, you can account for that for the, say, 40-year-old that retires early. In your book, you can run through what your safe withdrawal rate is and not just pick a number out of thin air, right?
The withdrawal rate is very sensitive to your time horizon. The longer you're planning for, the lower your rate goes. Let's say with a 4.7, with the 30-year folks starting out 30-year with 4.7%, it will not drop below 4.1%, even for 50, 60, 70, 80 years. It kind of reaches a floor, which is good news. A result of the fact that you have spent longer time in the market, you'll make more money. So it offsets the effects of withdrawing over that very long time period.
So you heard it here, firees. We don't need to pick 3.25% out of thin air. We don't need to pick anything under 4% out of thin air. We can spend more in retirement and use the 4.15 or 4% rule as our floor. That's what I heard here.
If you're looking at a 3% withdrawal rate, you have to save about 30 times your first withdrawal. While if you're looking at 5% or let's say 4.5%, it's a lot less. So it takes some of the burdens off the savings and allows people maybe to enjoy life today. It's not all about retirement. There's a balance between pre-retirement and retirement you have to achieve.
Your research, the 4.7% floor, or say even the 5% rule, maybe it'll become known as that, is very important for late starters because we may not be able to save necessarily as big of a nest egg as the person that started early, but we can, if we structure things appropriately, still retire sooner than we think with a higher safe withdrawal rate, correct?
That's right. And once again, keep in mind that 4.7% is the worst case scenario. If I was a person retiring today, a fire person with looking at 50 years of retirement, I would probably recommend to them somewhere in the range of 4.1%, which was that floor, maybe 4.5%, 4.6%, which is a significant increase on their expenses they can enjoy during retirement.
I will take that advice. I retired when I was 49. And so I'd give myself about 50 years. I have longevity in my family. So thanks for giving me permission that I might be able to push that up just a little bit. But one area that you have as a variable that does kind of bother me a little bit is the taxes. Can you talk to us a little bit about the impact of taxes?
Sure. If you're dealing with an IRA or a Roth IRA account, it's not an issue. But if your primary source of funds for your retirement withdrawals is a taxable account, then you're going to have to calculate the impact of taxes on your withdrawals, which I do in my book. And the big message there is the higher your overall average tax rate is, the lower the withdrawal rate. And it can significantly affect the withdrawals you make. Once you pay taxes, that money is free. So it may not be as big a difference as you might think.
Well, this is a good place to actually talk about your standard configurations for your research. Can you take us through what your standard configuration was based on these inputs and variables back in 1994 and how it changed today for this new book?
Yeah, I probably should have looked it up a little bit because there are the 8 elements. I don't always remember them all. So give me a second here to get to a digital copy of my book.
You asking about the asset allocation or?
Yeah, that's a big part of it. That's one of the big changes in the structure. But the 4% rule was based on a 50% S&P 500 portfolio with basically 50% intermediate treasuries. It was configuration of 2 assets in order, and that was where you could get the data in order to come up with your, what we would call back then, safe max of 4%.
That's right.
Okay, and then today, your standard configuration for at least the variable of asset allocation has changed pretty dramatically. Can you take us through what it is today?
As far as the asset allocation?
Yeah.
I don't know if it's really changed that much since my original research, surprisingly. It's held up pretty well. The curious thing about the whole thing, and this is one of the first things that I learned when I started doing these calculations, I was looking to see the effect of stock allocation on the withdrawal rate. So I created a chart with stock allocation at the bottom and the withdrawal rate along the side. And I do a chart. And I thought it would be something that would be just sloping line from lower left, upper right. It wasn't. It was more like a mesa, an old West Mesa, where there was a slope on the left and a slope on the right and a flat area in the middle. And that flat area encompassed anywhere from like 45% to 75% stock allocation. It didn't make any difference what number you choose within that range. You ended up with the same withdrawal rate effectively, just the way the dynamics of portfolios and withdrawals work. But if you have too much in stocks at the high end, your portfolio is subject to a big bear market, can get hurt, reduce your withdrawal rate. Same thing on the other end. If you have too much in bonds, too few in stocks, bonds just don't return very much, so that they don't have the oomph to your portfolio need to get a higher withdrawal rate.
Yeah, and then the allocation you use for your book is a little different. You talk about a 55% equity allocation, and you divide that up equally among 5 asset classes. Quote me if I'm wrong, but it starts with the S&P 500 in growth. You have mid caps in there. You have small caps, but you don't, I think, have a value tilt in there necessarily. And quote me if I'm wrong there. You have internationals, total international, and you have micro caps. And so you divide your 55% equity allocation into 11% aliquots of those 5 asset classes, right?
That's correct, in addition to the bond asset classes. I should state that both the micro cap and small cap have returned quite stronger than the S&P 500 over the last 100 years. The question is, what will they do going forward? What's happening in the small cap world? There's a lot of the best and fastest growing small cap companies get siphoned off by venture capital, private equity, and they're not available for purchase by mutual funds and exchange traded funds, which we would normally be investing in. So there's some question whether small caps and micro caps will be able to maintain that return advantage. Certainly over the last 10 years, they greatly underperformed the S&P 500. But that's happened before, and they followed by a period of tremendous overperformance. It's something just to keep in mind. This is a dynamic world we live in, and we have to be prepared to change.
With regards to your small cap allocation, was it total small cap based on a certain index that you picked? Because it does depend a little bit on the index, or did you focus on small cap value there?
I use CRSP, CRISP index, and that's just a general small cap market exposure. No factor, no value or growth considered in it. Everything's in there.
For the stock allocation or equities, what if someone used something like a total stock market index fund? Would that get it done, or do you think that would harm them? What are your thoughts on that? Because I know a lot of people like to keep it simple and might stick with something like that. So what do you think? Would they still survive and be okay?
I think that would be a good foundation for their portfolio if they want to put a large chunk of it, but I think they also ought to supplement it with assets in other classes like small cap value, emerging market value. These asset classes are very cheap now and should have really great returns going forward. Precious metals, maybe Bitcoin, maybe alternative investments, real estate investment trusts, and so forth. I think the better diversified portfolio you have, the better off you'll be, because we really don't know what assets will return in the future.
I think what you found, at least according to your book, was you got a big boost from small cap. It was about 0.5%, I think. And then you saw less of a boost from additional asset classes, meaning the other 4, the international, the microcaps, and the midcaps. And that's where you ended up at the 4.7% rule. And you mentioned alternative assets. One of our friends, Frank Vasquez, is a big fan of, say, what he calls a golden ratio portfolio in a risk parity style portfolio, where things like gold are included and then long-term bonds are included. Do you think adding those other assets, and you mentioned it, would boost your safe withdrawal rate?
I can't really answer that without doing an analysis, but I just think from general principles, having that diversification is valuable because you don't know where your returns are going to be coming from in the future. I would think particularly one of those classes you mentioned is pretty cheap right now and might be a good time to be investing in that.
So do you think your future research will look at adding alternatives to the portfolio?
Yeah, I mean, I've had requests from folks about that, and I'm trying to understand that world a little bit better than I understand right now. It's not a cut and dry thing. You have to understand what's happening, what the valuations are for private equity and so forth, get a handle on what the options are. But that's what I guess universities have used very successfully now for some years, right? Although my understanding is that their returns have been diminishing in alternative investments for some time. So once again, I don't know enough about it to express a solid opinion at this point. I'm still studying it.
Yeah. And Bill, since people ask you about some of these things all the time, I really love that you have a section on your website that's basically Ask Bill. So you can go to his website. What's the website, Bill?
Yeah, it's www.bengenfs.com. FS, the financial services, my old moniker. And yeah, I welcome inquiries from people. I can't really answer questions specific to a particular situation. I'm not a financial advisor anymore, but I'll be happy to entertain questions about my research in general, any way I can help.
Yeah, and you include a lot of tables in the book, but you have further tables, further elements of your research, your future ideas on the website. And it helps people also figure out their configuration of the variables so they can figure out their own safe max withdrawal rate. So the website's very robust, and the book is a great place to start. But if you want the latest and greatest that Bill Bengen is doing, look at his website, right?
Yeah, I'm building it, the content. Take me some time to build it. I'd like to be a home that people can go to, find the information they need to plan for a 30-year or 40-year or 50-year horizon, or a taxable account or a tax deferred account or some other withdrawal scheme. That's going to take some time to build.
Our listeners are probably wondering about themselves. They have a base case, and the examples that you provide will allow them to say, okay, this looks a lot like me. I want to have a sense of what would my numbers look like in this particular scenario. So I love the sample plans and the different types of scenarios that you put together. And I think it's very helpful. So go to his website, take a look at the book, and the samples can be really, really helpful because there's probably one that's very close to what you're thinking about as you contemplate your safe max or your withdrawal strategy.
I think 5 cases in the book that he goes through, and I found those fascinating. We haven't gone through all the variables or elements yet. We need to mention to people a few more. We're at number 6, and people wonder about rebalancing. Should I rebalance every month? Should I rebalance every quarter, every year? Should I never rebalance? What are your thoughts on that and all those schemes?
Yeah, the overall analysis I did indicated that rebalancing is not a big deal for retirees, but it's probably still a good practice to do it at least once a year, rebalance your portfolio. Because I've been able to demonstrate that you actually can increase returns by rebalancing. You get these assets doing different things at different times. When you rebalance, you sell off assets which have done well and probably about to do less well, and buying assets that are cheaper and probably ready to do better. So it kind of gooses your returns over time. It's like a forced value investing strategy.
Yeah, you talk about the 4 free lunches that an investor should enjoy. I think rebalancing is one of them. What other free lunches do we have as investors?
Diversification is another one. Another free lunch is what's called rising glide path investing, which is a really interesting idea developed by a couple of advisors, Michael Kitces and Wade Fowle, about a dozen years ago. And they just wrote a paper in which they studied what happens if instead of a 60% stock allocation of 55, we start with 30 and then increase it over time. When I tested their ideas out, it actually gave an increase to withdrawal rates by doing that. Kind of counterintuitive, but I think the main feature there is that if you run into a bear market early in retirement and you're using this rising glide path approach, you have a low exposure equities, maybe 30, 40%. The bear markets don't last forever. There will be a recovery. And when you're recovering, you're increasing your allocation of stocks. So essentially, it's almost like momentum investing for retirees, but it works. And I don't know completely why it works, but it seems to work across all my 400 retirees.
Yeah, I mean, the glide path for target date funds is the opposite. I mean, it has a reducing glide path for a conservative purpose. Do you have any thoughts on target date funds, passive target date funds, and their sort of glide path geared towards the average everybody?
Yeah, I'm not enthused about the concept because I think if you're in the pre-retirement phase, you probably ought to be 100% in stocks almost all the time, up to within 4 or 5 years of retirement. Then you start making the transition. After retirement, you should have an allocation, which is probably either fixed or a rising glide path, and neither one of those is covered by those funds you mentioned.
Yeah, I noticed those target date funds, a lot of them do seem to have more bonds than Bill Bengen thinks they should have, unless they're 5 years away from retirement. So something to be said for that if Bill Bengen is saying, maybe all stocks until 5 years before.
The big message here, the big picture is, you just heard it here, 100% stocks, total stock market, S&P 500, until you're 5 years away from retirement. If you can stomach the volatility, transition to a retirement portfolio over 3 to 5 years that should be more diversified. You want to keep it simple, but not too simple. You use 5 equity classes. People could throw in other things other than maybe micro caps or mid caps and create their own 5 equity class and 1, 2, or 3 bond class. You're not seeing more than, say, 6 or 7 equity and fixed income asset classes that you can rebalance. But you think it's crucial that retirees diversify, right?
Absolutely essential. Yeah, because you never know where returns are going to be coming from.
So we talked about rebalancing. You have an interesting strategy with regards to risk management versus market timing. Can you tell us a little bit about your risk management approach that you used actually for your own clients back in the day?
Yeah, you bet. Although it's more sophisticated now than it was. I was a buy and hold investor for a long time, which means basically you buy your allocation and you just hold on to investments, don't sell anything unless you need cash. And that, to me, worked pretty well up through the late 90s. And I remember we got into the dot-com boom and the stock market went crazy for 5 years, got to ridiculous valuations, and was followed by a crash. The NASDAQ actually lost 83% of its value. And it was due largely, I think, things that are happening in government. Monetary and fiscal policies are a lot different than they were 40, 50 years ago. So we live in a different investing world. And I felt that those policies were effective being used and had a great impact on markets that I did not want to buy and hold anymore. I wanted to be able to adjust the risk in my portfolio based upon the perceptions of risk in the stock market. And it's not something I did for a while, but I found a third-party service which I think does a better job. So I use their information and their recommendations diligently. For example, right now they're recommending hold about 60% of what you would normally hold in equities. So if you're normally 60% equity, should be 36% with the uninvested portion going into a money market mutual fund. And the idea there is that this is probably a high risk time for the stock market. Valuations are high. I heard Jerry Grantham, the famous advisor, investment manager, the other day saying this is the most highly valued stock market in U.S. history. And generally, what follows is not pretty. So you just have to be aware of those factors and accommodate them.
Yeah, your tables in your book actually go up through 94 or so with regards to calculating the cyclically adjusted PE ratios, and you use it into the mid-20s or so. We are at 38 now. So has the 4.7% rule already failed? And what do we do with regards to these high capes we've been seeing for years?
For a 30-year portfolio, ideally, you'd like to have 30 years of actual data. We do know that the fate of any portfolio is pretty much determined in the first 10 years. So I can look at portfolios, let's say recently as 10 years ago, which had high capes, and calculate a safe withdrawal rate for them. And they're generally recently been in the low to mid fives. One investor retired in April of 2009 was actually able to take out 8%. And it's 17 years later, they're going strong. That's because they got lucky. They bought into a cheap stock market. Right now, I can't say that about U.S. stocks, and I have no idea. I'm not predicting what the stock market's going to do. That's too difficult for me. But historically, a high valuation like this don't last forever.
I feel like we've been talking about the stock market seeming like it's so high for a long time. And we've had some minor pullbacks, but you're a research guy, and clearly you have not lost your passion for research. So when you were doing this book, I know you've been working on it for a while. How long did you focus on the research and start to formulate this book? I think it's longer than average, but I have a feeling you really, really enjoyed the research that came along with this book.
Yeah, I did, because there were always new things to discover. It took me all of last year, 2024, to write it, and early into this year as well. And the calculations, there are so many thousands of manual calculations, it's hard to describe. So I didn't find it boring because every calculation I did gave me a new result, another piece of data.
And I think everybody has their own passion. Like what other people might think is boring, you find extraordinarily fun and you're passionate about it. And I just love to see it. Like I said, the last time we had you on the show, we talked a lot about the book you were working on. I didn't know when it was going to launch. And you have just given a gift to individual investors, consumers, and just people that are going to get so much out of this for the Bill Bengen to be making sense of this to where they can understand and apply it in their own lives.
Well, it's kind of you to say that. I want to give back to folks. Over the years, a lot of individual investors have contacted me with questions about my research. That's one of the big reasons that prompted me to write this book for the non-professional. I wanted to explain it to everyone else.
Yeah, and I'm interested, and you may not have time right now, but I'm sure you have a list of projects and items you're interested in the future for, say, the next book, because investing and asset allocations are changing now that we have access to so many things on a cheap basis. What kind of questions are you asking yourself for the future?
Yeah, some of them are kind of obscure, but I'd like to do a more comprehensive test of the rising glide equity path. I felt my analysis was fairly decent, but I do a lot more things I want to look at, variations, starting with different withdrawal rates or stock allocation, and tested under a variety of conditions. I mentioned earlier that Professor Schiller's cyclically adjusted PE ratios, CAPE, is a cornerstone of my research because I use it to help determine the withdrawal rate. But he's come out with a new version of it, and I want to test how my data holds up against the new version of his. It's supposed to be more accurate. And then it's a long list of topics people have suggested. One of them is the impact on small cap stocks of returns. If they don't regain their former luster, what are we going to have to do with the space we formerly devoted to small cap stocks? Are we going to have to reallocate it? And if so, how?
Well, that's great. We have to remember that our audience are late starters. They're finding their way at, say, 40, 45, or 50, like myself. Jackie found her way and started her path at 38, 39. And people feel late and they're worried about catching up to FI. And we think that that's the average consumer, the average person in this culture based on consumption in our community, where we grow up learning to spend faster than we learn to save and not the reverse. What do you do if you're a late starter? Anything different?
Seems like our whole society is built backwards. We spend perhaps too much before retirement and spend too little afterwards. I would like to get people thinking more in the opposite direction. We save more during the pre-retirement period and get ready to enjoy spending that during retirement. It's a whole change in mindset.
The path, we've sort of advertised it as a 30 to 40% savings rate, a 10 to 15 year path. And you could follow the 100% equity for 10 years, transition down 5 years to your retirement portfolio, which will look different than your accumulation portfolio. So in my mind, anybody can get there in 10 to 15 years. Do you feel that way too?
Yeah, if they're willing to save the amount required to do so. And you've always got compound interest working for you. The eighth wonder of the world, according to Albert Einstein. So why not put it to use?
Well, and I think some of these other variables that you mentioned has to be considered too, because they're not taking all the money out all at once. So even if they feel like they're a late starter, some of it they'll spend in their 60s, some of it they're spending in their 70s, some of them they'll spend in their 80s, and they can look at all those variables that you mentioned to determine what might work for them, especially as a late starter. So that's why I really love that you put in some of these variables that people can just say, okay, this works for me or this doesn't work for me. Bill, tell us the name of the book again.
A Richer Retirement and Supercharging the 4% Rule to spend more and enjoy more.
Yeah, it is a mouthful, but it says exactly what you want to say. And I think the message from that title is that it can be simple and we want you to save more because it's out there that we tend to be a little too conservative. You went from the 4% rule to even more, possibly even 7%, like you mentioned. So that is, to me, the big takeaway, that we can spend more than we thought we could.
We have a new number to figure out our FIRE number and our safe withdrawal number. You heard it here. Save more and then spend more based on this. And you can get there faster with the 4.7% rule, and you can spend more in retirement. We have people that oversave and underspend. You're telling people that you can do retirement better.
I agree.
This is all from the great Bill Bengen, that is a research guy. He's going to do his homework and he's openly sharing it with you. So this is valuable information from a very highly trusted source. So thank you for bringing this to us, Bill. Thank you for spending time with us today and having your lovely wife, Barbara, join us in the beginning. This was such a treat, right, Bill?
Oh, I love it. I mean, I am very fortunate that Bill actually asked me to write a blurb in his book. I'm in here with Mary Beth Franklin, Larry Swedroe, Michael Finka, Wade Pfau, Michael Kitsis, and there is Bill Yount, MD, creator and co-host of Catching Up to Fi. And let me read what I said, and we'll end the show here. With his new book, Bill Bengen, aka Mr. 4%, takes the reader with him down his rabbit hole on a journey to a new Safe Max portfolio withdrawal rate of 4.7%. He masterfully takes us there using new data and research that is at the same time consumer-facing and financial advisor-friendly. His 8 elements of a personal retirement withdrawal plan are wonders of the modern financial planning landscape. Bravo, Mr. 4.7%. And thank you for being here with us today on Catching Up to Fi.
Well, it's been a pleasure. You folks are always a lot of fun.
Did you hear that, Jackie? We're fun.
I know. He's a lot of fun too. This is just a joy for us. Totally made our day. And we are so glad that the book has done so well already. It's only been out short time, but absolutely deserving. And you will sell a lot more copies. So thank you for that.
All right, Bill. We'll see you next time on Catching Up to Fi. This isn't the last word from Bill Bengen. There's more to come.
You bet.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.